I'm going to quickly walk everybody how to do a bond issue price calculation. This problem I have up is very similar to the homework that you are doing. And when you do your Excel sheet, I would like you to show me how you actually calculate the issue price of a bond. So, on January 1st, 2016, Valley Enterprises issued bonds with a face value of $60,000. So we know that bonds need to have a face value, $60,000 in this situation. A stated rate of interest of 8%. So it's important to know that the stated rate of interest is the rate that cash payments are made at. So this is the amount of cash payment for interest that I am always going to be making. So if I take the stated rate at 8%, if you multiply that out, we are paying $4,800 every single time we make a cash payment. It's a 5-year term, so 5 years is my term. Interest is payable in cash at the end of every year. The effective rate, also known as the market rate, is 9%. 9%. This is what we use to discount the bonds. The problems in the book give you what the actual issue price was, but you do have to know how to actually calculate that and then plug into the effective rate method. We don't straight line this. We actually use the effective amortization because we are actually using time value of money to discount this bond. And it goes along with matching, which I'll get into in a minute. So the first thing that we need to look at is what is the premium or discount that's happening with this bond. Since it was a bond that was issued, the stated rate versus the market rate, in this situation, the stated rate is less than, it's 8%, versus the market rate of 9%. So this means that I'm selling my bond for a discount, meaning my interest that I'm paying is less than what the market interest rate is paying. And again, we're assuming interest rates stay the same, which we know is not reality. The other things that you could possibly have is when the stated rate is greater than the market rate, that would mean that you would have a premium. And if the stated rate and the market rate were equal, you would have an issue price equal to face value. Since we know it is a discount, I'm expecting that the issue price will be less than the actual bond's face value. This is the face value is what I'm getting back at the end of the term. I'm getting $60,000 plus the interest every single year. So when you calculate what your actual bond issue price is, you're going to look at first step is take your face value of $60,000 and you're going to multiply that by a factor. How do you find the factor? You use the market rate. This is the only time you use the market rate and the years or the periods to find your factor. Since we're discounting, meaning we're bringing it back to today's dollars, this $60,000 we're going to receive in 5 years. We want to know what is that worth today so we can find out what would someone pay for that. If I look at my market rate of 9% for 5 periods, I get 0.649931. So 0.649931, which calculates out to $38,996. Step 2 is take your interest payments, interest cash payments, and find out how much you are giving them in the future with interest and find out what it's worth today. So my cash payments are $48,000. Even though the market rate is 9%, I am only paying bondholders 8%. There's many reasons for that. It might be that the company cannot afford to pay the cash interest of 9% every year. That's why they're issuing their own bonds. We can take the 4,800. Again, we're looking for our factor. In this situation, again, 9% because we're using the market rate. It's the only time we use the market rate, and the years. This was the present value of one lump sum because we were only giving back $60,000 one time in year 5. In this situation, we are actually using the present value of an annuity. What's an annuity? When you pay the same amount every year for multiple years. So we're paying them $4,800 every year for 5 years. What's my value of that today? Well, I can take the 9% at 5 years, or 3.889651. 3.889651. Now, if you did this out and used the stated rate, when you calculate this, your issue price would have been the actual $60,000, which is the face value. So when we calculate this out, we get $18,670, issue price $57,666. That does in fact agree with the issue price that's here. So when you're doing your homework 1020 and 1021, you need to be showing this calculation on your Excel sheet. I need to understand that you do get it, that you know what's happening. How does this look under the accounting equation? Very important to understand. Assets equals liabilities plus owner's equity. What is my cash amount? That is the issue price. I'm getting $57,666. Bonds always go on the books for what their face value is. I say always, but it's not necessarily true. But bonds payable do go on the books for our class for what they are going to be paying back in the future. So we know this is the liability that will be paid back in the future. However, the debits and credits don't equal. Why? Because there is a discount that happened. I did not issue this for market equaling stated rate. There was a discount. So I have a bond discount for the difference of those amounts, which if you take your $60,000 and subtract that from the $57,666, you get 2,334. What does this discount actually represent? It is interest. The bondholders are giving you $57,666 today, but in 5 years they're getting back the $60,000. So they are getting market rate. It's just taking them 5 years to do that. Now I mentioned matching principle. It'd be wonderful if we could just say this discount is actually just interest expense in the year that it happened. It'd be awesome if we could just say, oh, interest expense 2,334. Why can't we? Because this interest, this additional interest is going to be earned over a 5-year period. It doesn't happen all at the date the bond was issued. So we cannot put the expense all in 1 year because we're giving this bond out. The reason we are issuing a bond is to help us raise cash to hopefully help us generate more revenue. Matching says match your revenues and expenses in the same period. So we can't do that. Your book talks about taking this amount, dividing it by 5, and using straight line to amortize it. But we're actually going to be using the appendix method, which is the effective rate, which is what is used for GAAP purposes, generally accepted accounting principles. So you have to take your bond payable and your bond discount, and you're going to be taking this over to expense based on a formula that I'll show you in a second. But that is how you calculate the interest price. The next video will be about actually amortizing this discount.